All right, it is showtime. Welcome, everybody, to the Naples Vice podcast or show or whatever it is that I call it. I think I need to be a little bit more clear on that. So, it is Sunday, and we're going to kind of recap what happened on Friday with China coming out and saying that supposedly they like this trade deal that Trump comes out with, blah, blah, blah. And we hear some conflicting stories on both sides, which was fascinating. It was a very weird day, very strange just by the way that the market reacted. You could just kind of tell that there was some kind of strange goings on in these markets regarding the trade scenario. So numbers right now, Friday, 135 on the Dow, up 3 points. S&P 3168, up less than 1 point, up about 0.2. NASDAQ 8734, up 17 points. Now tech getting a nice little jump out of there. The other two couldn't quite get any direction. We did have bonds coming up a little bit. Yield on the 10-year, 1.837%. Gold, actually, and this is what was fascinating about this on Friday. We had a rally in gold and we had a rally in bonds, back to back, rally in yen. So there was uncertainty out there. Oil futures, which are open right now, down about 21, but on Friday, we did get really close to that target that I've been talking about, 60.5. I believe we actually hit it on a wick, but it didn't close up there. So in my eyes, if the candle can't close up there, it doesn't count. That's just my own personal opinion. Euro 111.26. The euro, that was a fascinating story. I believe I covered the pound. The euro got all the way up to over 112 on Thursday night, and it proceeded to sell off pretty heavily against the dollar all day long, and I believe it actually closed negative after seeing a huge gap up. The pound is, it pretty much came way off that 135 area that we saw after the results of the British election. We came up to a high in the pound around 135.13 against the dollar, and they ended up selling it all the way down to 132.97. They did gap it up a little bit on the open. If the pound doesn't sell off here, it'll probably stay sideways. I don't think we'll get a whole lot more action to the upside in the pound. So if you were short calls or you sold call spreads or strangles or anything like that in the pound last week, you should have been doing all right, because I assume that they're going to hammer volatility this week in there. Once again, I'm not trading it directional because right now, after something like that, especially a big reaction to a news event, we just kind of want to let them settle a little bit. Kind of let this market digest all this information about the election. Soybeans, we did have we had that same strong reaction, which I went over last week, are gapping up right now. We had a open, and it looks like we're higher off the open around 912. We're sitting about 914 right now on the beans. Gold, like I said, 1478. Not going really a whole lot of anywhere right now, but that's okay. We still have a little bit of time before a lot of the Asian action starts coming into this market. CBOE skew, which is, it's an index. You can get it on TradingView for free. It's the put call ratio, and it just gives you an idea of what open interest looks like relative to puts and calls. The way that this index is quoted, and I'm not sure if this is the standard, if they how exactly it is, but this is the one that I use on TradingView. And we have a rising put call ratio to 144 right now. So typically when that thing's rising, so it's the stock market, once it gets to an extreme, we start to see a pullback. That's one of those confirming indicators where I'm not going to sit here and start selling S&Ps because the skew is soaring or it's going high or whatever. But if the skew is moving to the upside, it's something that I would consider. It's you see the nines, you see setup trend, you get some kind of news from Donald Trump, whatever it may be, and then you see that skew is popping up, it's coming up. Okay, that's a sign that we want to start taking a look at some things. A new one I'm learning, and as soon as I learn this and I figure this out, this is the trend. In other terms, I believe they also call it the ticks. And it just kind of gives you an idea of, I think it's the same thing as a skew. It tells you, like, if you see an extreme on this thing and a big price extreme, you want to start thinking about closing your position. Same idea. I'm trying to look into other layers to where if I'm going to be trading mostly the S&P 500 through the E-mini S&P futures options, then I want to have as much data as possible so that I can make the best decision possible. So enough from price. We're going to go check out some news. And this is, I want to talk about the China deal. Maybe something fascinating on CNBC. I'm going to go over other news as well. Democrats won the House. White Houser. Kind of makes your eyes bleed a little bit when you see all this. Yeah, we don't really have a whole crazy deal of news to go over this weekend. It was relatively quiet. However, when it comes to Friday, so it looks as though, allegedly, and this is not the first time that they've said this, that we've got a phase one deal with China, and they're going to go through with it. China came out with a press conference that, was basically bolstering the narrative, saying that we're very excited to work with the U.S. and do lots of trading with the U.S. and blah, blah, blah. The Trump administration talks about $50 billion in ag purchases. China never agreed to that on paper. All right, and that's why the market was a little bit iffy about this whole thing on Friday and closed with quite a bit of indecision, because instead of rallying like you would have thought coming into this deal, the deal wasn't clear. There's a lot of questions that were unanswered, and the market, I think, kind of realized that this deal wasn't what they wanted. They wanted it on paper, and now they're putting off the signing of the deal until January. So, beginning of January, I believe, they'll probably change it again. So I'm not so focused on the date itself, because I guarantee you, as soon as that date closes in, there's going to be some kind of thing that comes up. Guarantee it. This whole trade deal has been just a big farce from the get-go. So just, trust me on that one. So, they put off the date to where they actually sign it. They have to go through bureaucracy, translators, and XYZ thing, which is why I'm just totally skeptical whether or not they're really going to get this thing through or not. In regards to my thoughts on where I think the market could be headed after this, I honestly think that we're going to probably be flat to lower going into the end of the year. That's my opinion. I'm staying away from the S&P 500 right now until we get a little bit more clarity on this, because I have a feeling that we could be getting ready to have a nice move to the downside. But at the same time, with the Fed, now coming out saying that there's just not going to be any limits anymore on their overnight transactions. I just don't feel comfortable with being in the S&P 500 or being in stocks right now. I don't. And when I don't feel comfortable, when I feel uneasy, that's when I just sit it out. And the way that I justify that is by having high probability setups that I can go through and see that work time and time and time and time again. I use low risk trades, so I can use a lot of size, use a lot of leverage in the options market. So that's how I justify it. So I'm going to stay away from the S&P for a while. That's just me. I don't have time to sit here in front of the screens all day and day trade, so that's not an option. But for those of you big shots out there that have the time and you can be at your computer all day, that sounds like something tremendous to do. Day trading, day trading just for me just doesn't work out. That's me. That's my personal preference. I don't like day trading. I like overnighting, which I guess you could consider to be day trading, trading an overnight, position. Volume oscillator. I'm also setting up my chart because I'm going back to a more volume-based focus. Volume is so important when you're trading anything because if you have a big move or you have a lot of volume right at a market that's really had a pretty ginormous move, sometimes I can give you hints into when a market's getting ready to turn around. And on the S&P 500, there's massive volume both the day before the trade deal and the day after. And the fact that so I consider the beginning of the rally to be at the higher low, not at the exact bottom. So the higher low is 2894, so we'll just call that 2900. We've had a 280-point rally in the S&P 500 since that would have been the 9th of October. All by trade, I think it's all by the Fed. So when we start seeing big volume right up at large peaks like that, that's when I start getting fascinated. After a large move, that tells me that maybe somebody's taking a little bit of profits here. Now, I mentioned the S&P 500 being in a range. So we're sitting on the S&P 500 futures right now, which are sitting at 3180. Say we turn around right now, I see us staying between 3075 and around the top here. Maybe we go a little bit higher to 3200, but I think until this trade deal gets signed, there's a lot of questions that have to be answered. And if we continue to see gains, it'll just be evident that this market's driven more by the Federal Reserve than it is by this whole trade narrative. I think the trade narrative is just an excuse to pull back the market, to buy. Okay, so we've got 8:30 right now. I'm a little bit earlier than normal. The Nikkei is a little bit lower, down about around 45 points right now, or 0.1%. Markets I'm watching this week. I've been talking about gold, and I got stuck in the little trap last week in gold, and that's what burns me. I know how to find great trades, but when you're focused on just a couple of assets, and I've noticed that this is the problem. You overtrade in a different kind of way. Because in my eyes, overtrading was always, oh my gosh, I have 20 stock positions on right now. To me, that's overtrading. Well, you can do the same thing. So we had the day that would have been Thursday, when Donald Trump came out and did the tweet, we're very close to a deal with China. We had the big rally in all three indexes, and they came out and just decimated gold and silver. Well, with the lack of clarity, and I was bullish before that day right there. And that's why sometimes it's important to not let one day take you away from seeing the bigger picture. So Friday gold came right back, and it actually did a pretty nice pattern where it closed above the open of Thursday's candle. So I have my eyes on gold. And the reason being is that there's two factors. I mean, you have the stock market, which I'm going to say this, and anybody that trades S&Ps is going to know what I'm talking about, or really anything for that matter. You know, I can sit here and say that we've had a 280-point rally in the S&P, and we need a 50 to 100-point pullback sometime soon. And somebody can come out and say, "Whoa, you know, that could happen any day now, or it could do whatever." People, they take a trade because they listen to somebody on the internet, and then they get upset. Well, like I said, I want to stay away from the S&P, so I'm looking into my smaller group of assets that I like to trade, and gold and silver are one of them. You know, S&Ps, soybeans, sometimes crude oil. You know, and my small little handful of things that I'm comfortable with. Well, gold. All right. Number one, we have uncertainty about the trade deal. Okay, the stock market can continue to rally despite all the uncertainty, but I think on Friday they really proved to us that there's some fear out there, despite the fact that the VIX, ended up being down quite a bit, which means that they're liquidating those put positions and buying up those calls, which that's okay. I think they spoke in the bond market. I think they spoke in the gold market. And I think they spoke on the yen, that there's fear out there. It's real. And it's going to continue until we actually see something materialize from this trade deal. All right, that's factor number one on the more fundamental side for gold. Number two, the Federal Reserve, I mean, they just, it always comes back to them. It's kind of disgusting. But the point being, they're just getting ready to just print money like it's bananas. And they're pretty much telling you that. If you know how to listen to these guys talk, they're pretty much telling you what they're doing. They're going to be printing money because they want to be on target with their 2% inflation. And supposedly inflation's only at 1.6%. Confirm those numbers. That's what I hear. And that's, those are the government numbers. I know that that's not the realistic inflation. I know, I get that. For any gold bugs out there, I understand. But that's the information that we have, and that's the information that usually moves the market. So we have that. We have the ECB that's pretty much the same. All these central banks are just printing money to death. And they're going to, you don't see it as much in the dollar, but I think that'll be enough to send gold prices up a little bit. So you have uncertainty and you have central bank activity providing something in gold. And gold, looking at it from a more technical standpoint, because I always want to be more technical. Okay. We did have the big sell-off back here in my handy-dandy chart. I don't have to write anything down. It's great. The week of the 4th of November, we had a giant sell-off in the gold market. We had consolidation. That was a 9. That printed setup trend that supported gold nicely. And volume has really held up ever since in here. If you are a fan of the 2 going above a 1 thing on the sequential, you have that there. And furthermore, I want to make sure that we have we don't really have a major support level here at 1480. Back at the low, and not really either. But the really important point is that if you're looking at it on the weekly chart, it almost looks like a flagging pattern. Sequential setting up, volume staying strong. So I am looking for something in gold. I got a 1530 target as the first stop. And I think we could do that in 2 or 3 weeks, even 1 week. I mean, if we really have a fallout with trade, or we get something more from the Fed about them putting their repo operations on steroids, that could be enough to get gold coming up to that 1530 area easy. 1530 area wasn't the high of the last swing. We got about 1562 as the peak of the last swing. So that would be, we'd have 1530, which is more of just my target because I have an options trade on. And for that trade to work out, I want to see a 50-point rally in gold, because I got the 1505 calls about 2 weeks out. And I think that, seeing a nice $25 rally in gold is something tangible, being that we're in the environment that we're in here today. The ultimate target, I suppose, for this swing, if we're coming up into an uptrend here, which I think we are, we have to get through the high, obviously, 1565. And then I have a Fibonacci extension, excuse me, of the most previous rally, which is, it's 1272. It's the one I use. And that's sitting at 1648, which I know is it's a pretty lofty target from here. And you can call that crazy. That's about 50 points. We're sitting at 1477, 150, 170. It's close. It doesn't matter. It's not the point. So I'm looking at this shorter term, going back to the beginning of 2019. And if you're an Elliott guy, it looks like we're going into a 5, and 5s tend to be the most violent to the upside. They're not the longest, but they're the sharpest, because that's when all the suckers are getting in. So, at the top of the trend. So I'm really going to be keeping an eye on gold, both in the short term and in the long term, really going into the middle of this coming year. Because if we're going to get up to 1650, it's going to take some time. It took us, let's see here. Okay. Yeah, it's going to take us some time to really get a big rally like that. A couple of weeks at least, maybe even 2 or 3 months. So that's what I'm going to be watching primarily. Soybeans continue to be strong, but that's another story right now that is far too connected to the trade kind of narrative going on right now. And we might have a big rally in there. We could, but I have a feeling that they're getting ready to really wreck a lot of people, especially a lot of these longs that refuse to cover in soybeans and in the S&Ps. I'm just staying away from all that. I already talked about crude oil getting up close to that area. That's another one we'll be watching this week. I mean, crude's been sensitive to the trade narrative, but not as much as I would have expected it to. I mean, it's been pretty strong coming off of the bottom of its range at about $51. You got a sequential setup there. You do have some descending resistance, and then we're coming right back up to the exact number is 60.42, but that's okay. You got a 2 going above a 1, which is great. It's for strength, I don't believe that, but with OPEC, being very ready to pull the trigger on those production cuts, I think taking out this 60.50 area here could be totally possible. Maybe even this week. And if we go above there, we're looking for at least a rally to $70 a barrel on crude oil. So if we break that 60.50 and there's volume and that thing's holding up there, I'd be a buyer. That's one of those circumstances. That's going to be a longer-term trade, smaller position, longer-term options. CL has the liquid options, and you can get some pretty cheap ones out of the money. About 37 There should be about 35 days out now, right now, and I think that's enough of a move. If you go $2 or $3 out of the money, you can make a nice little return there. So on that note, those are the markets I'm watching this week: crude oil and gold. Um, like I said, I don't want to be in anything that happens to be too sensitive to any kind of trade data, because I just have a feeling, a little funny feeling, that with all the uncertainty out there, all it's going to take is the tiniest little spark to start feeling a huge volatility event, either to the upside or the downside. And quite frankly, I don't want to get burned out here. Preserving capital is the most important part of this game, as I've learned the hard way many times. So, for the Naples Vice channel, coming to you from beautiful Naples, Florida, this is Vincent Freese, and I will talk to you tomorrow, hopefully with more news. Have a good evening, and let's make some money.